Hello, hello. Welcome to the Five Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. Hello, hello. Abel Pacheco here, your host for the Five Talents Podcast, where we talk about financial freedom, multifamily investing, among other topics. And I'm just super excited today. We have an amazing guest, Mr. Gino Barbaro. How's it going, sir?
Abel, thank you for having me on the Five Talents commercial podcast. I don't know if I have five talents. So hopefully I have one or two. I'm not sure if I got five, though. We'll find out, right?
I have a feeling you have more than a few, my friend, from your background. And let me, for our listeners, right, I think we do have some followers that are new to multifamily syndication, so they really may not know you. And then we have probably more than a few general partners and other, people starting the world. They definitely know you. But for those that don't, to introduce, I know you're an investor, real estate investor, business owner, you're an entrepreneur. You grew your real estate portfolio to over 1,500 multifamily units. And now you enjoy teaching others to help them do the same. Adults, and also now I understand children. So it's awesome. We'll get into that. But you're the co-founder of Jake and Gino. It's an amazing multifamily real estate education company. I followed a lot of the content. I've been the recipient of a lot of that education and really just appreciate it on the outer fringes of. And I know you have coaching, training, you and also teach a proprietary framework that's like buy right, manage right, finance right. So, and also, so I know you're an author of a few books, Wheelbarrow Profits, Honeybee, Family Food and the Fryers. Man, you've had an outstanding run. Professional excellence in coaching, the institute of that, and you graduated there. Just man, all kinds of things. And then you reside in St. Augustine, Florida. You married and 6 children. I love it. Congratulations.
That's the best one. That's the best one right there. That's probably my best talent is being a father, being a husband and a father. And that's, Abel, it's very similar to multifamily, and it's very similar to everything else in life. You have your first child, you do your first deal. It's scary. You don't know what you're doing. You're never ready for it. I mean, has anyone ever said to you, I'm ready for multifamily? It's never the right time until you're ready for it. Right. And, being a parent, being a father, it's the best job in the world. It's a hard job. It's one of those jobs like multifamily. It's the long game. You don't see results the first 6 months or 12 months of a deal. Maybe it takes you 18 months to 24 months. It's the same thing with your children. You put in those years and years and years. And my wife homeschools the kids. So listen, up until they become adults, you don't know if you've done a good job or a bad job, right? When they leave the house, it's like, okay, we've done a pretty good job. So there's so many parallels between parenting and multifamily. Parenting and having a household is like running a business. That's basically what it's like. You have to have the discipline, and you have to have that hard work ethic, and just knowing when to pick your battles and just never quitting and knowing that it's a long game.
Yeah, absolutely. I have a 2.5-year-old and a 1-year-old now. Right. So me and my wife have been married for a number of years, and we finally, had children. But I thought I was busy beforehand, and I go, man, I have 2 little ones. I couldn't imagine 6. So there's a ton of parallel, a lot of lessons learned, a lot of education. I'm sure you're applying to your business every day, man. And what's the oldest and the youngest?
I have a 20-year-old who's a senior in college, and awesome. I have a 6-year-old who just started first grade this year. So homeschooling a first grader is awesome because they just And that's the thing. They love school. I mean, you don't want to push on them, but all of a sudden last year, kindergarten, she was not ready to read. We didn't push her. If it was our first child, we probably would have pushed her, made her sit down, do her work. This year, she just started reading and she's like, Dad, this is so powerful. So, awesome. I mean, that's what you got to do at school. Some kids just aren't ready. And as parents, it's just all about having the experience to know, to know when to push, when to hit the brakes. And it's the same thing with multifamily. You're not going to learn this stuff in a couple months, 3 months, 6 months, 12 months. You're really gonna have to dive deep, do a lot of reading, listen to a lot of podcasts, analyze a lot of deals, walk a lot of properties, talk to a lot of brokers, talk to a lot of investors, and then you'll start seeing similarities and parallels. And then from there, you'll start learning the business. And then from learning the business, putting in LOIs, closing on deals, it starts to get a little bit more familiar.
No, that's great. All of the nuggets that I'm excited. So, just jumping right in, why don't we take that, kind of as a jumping point. What do you do today to, get in this deal flow, get in this cycle, get in these efforts? So you talked about a number of education points, and somebody's brand new general partner and they're saying, how do I get into this today? How do I start? Where do I begin? What do I do?
I think the first thing, I wrote an article on this at jakeandgino.com. It's really the 7 levels of creating a successful multifamily business. I probably don't even remember all 7, but I know the first one, Abel, honestly, it's the epiphany. And the pandemic is going to give you the epiphany. For me, the epiphany was the Great Recession back in 2008. I had the restaurant. I was working there. I opened in 94. So I was there for 15 years almost. It was a great life. I had 3 kids at the time. I was making good money. The Great Recession comes, AKA the COVID-19 for me back then. Yeah. I had an epiphany. I'm like, I can't keep doing this. Grubhub is here. Does everyone remember what Grubhub was 20 years ago? They weren't around. My dad was an old school Italian. We didn't deliver food. You want food, you come pick it up at the restaurant, right? We didn't do any of that stuff because we didn't have to. There was less competition. Eating habits were different. And all of a sudden, that's what happened. I had the epiphany, the aha moment. I need to do something, right? So the second step was to take massive education. You got to educate yourself. Either pay to play or seek to serve. One of those two. And I paid to play. I spent a lot of money on my education. I like to call it investing in your education because you're not really spending money. As an entrepreneur, if it gives you a return, it doesn't cost you anything. If it makes you money, it costs you nothing. That's what it basically came down to me because I had done a couple of deals prior and I lost a lot of money in those deals and I wasn't properly educated. I chose my niche in multifamily and I went all forward. The third one is after you've done the massive education, stop going to those seminars. Stop being a seminar junkie and being an education junkie and listening to podcasts. If you've listened to 100 podcasts, I think it's about time to get off. It's time, right? So it's education times action equals results. I want everyone to write that down. Education times action will equal your results. That's what ends up happening. You need to take that massive action. And if you can't do it by yourself and you're scared, listen, I get it. I found an amazing partner, Jake. I found an accountability partner. I found somebody I could bounce ideas off of. I was going it alone in the beginning. I said, you know what, Jake, when you get down to Tennessee, because he was living in New York, he moved to Tennessee back in 2011. He moves down there. I said, let's start looking at deals down there because New York doesn't make any sense. We start looking at deals together. 18 months it took us to find that first deal, right? Massive education. I was teaching Jake how to underwrite deals, how to look at deals. It took us 18 months. We found that first deal. There was the action. Took that action. I think the next step is after that action, closing that first deal, putting in offers, talking to brokers. I think the thing is you start trying to identify as a multifamily investor, right? Because it was hard because I was in the restaurant business and I didn't think of myself as an investor. I had my pizza coat, my chef coat on, I had pizza sauce all over myself. I didn't feel like a multifamily investor, right? I didn't identify as one. Once I started identifying as one, I said, you know what does a multifamily investor do? We go out, we look at deals, we walk deals, we do property tours, we talk to investors, we put in offers, we call brokers up. Once you start identifying as one, you start taking those actions as one, and then sooner or later, you're gonna find a deal. If you're into it you have the clarity and you know your why, you're gonna figure out how to do this business. And that's what we ended up doing. We bought that first deal. We had the momentum. The next step was, wow, you get your second deal. 3 months after that first one, we got our second one. And then the 6 months after that second one, we got our third deal. And at 200 units, it was like, okay, the next step is you can't do everything yourself. The I'm a mentality. I'm going to do this and I'm going to do that. It works okay in the beginning. And the irony is you need to do that in the beginning because I think you need to learn the whole business. It's very hard for an entrepreneur. I mean, Even look at Jeff Bezos. Everyone looks at him now. But back in 97, all he was doing was selling books on Amazon. That's all he was doing. He wasn't anywhere near where he is now. He's probably doing the grind himself, but he realized that if he has to start growing, you have to start hiring people. And that's the inflection point where you become an entrepreneur. Like, I have to start hiring people. And it's hard because you've got to let go of certain things, right? Letting go of certain things that are less, you're generating less revenue is hard, but you need to do that. And if you don't do that, you will not grow. Let me give you an example. We started Jake and Gino. We were editing our podcasts. We were trying to book all the shows. We were putting them down, downloading them. Those are hours of work a week that we can outsource to somebody for a lot less cheaper. And we can use that time to actually go out and look at more deals, to raise capital, to do whatever you can to grow the business, where you can take yourself out of those menial responsibilities and give them to somebody else. So I think that's the next step. After buying a deal or two, realizing that multifamily is a business. People don't realize that. Jake and Gino, we like to say we create multifamily entrepreneurs, because when you're buying a deal, you're not buying just a deal. You're buying a little business. You're buying a little cash flow center. You buy another deal, it's the same thing. It's another cash flow generating business that has so many benefits, whether it's the cash flow, the appreciation, the tax benefits. So you start stacking deal upon deal. All of a sudden you start saying to yourself, wow, this is pretty freaking amazing, right? And then there comes the epiphany of, I start scaling up. I need people, I need systems, and I need culture. Because all of a sudden you can go from 30 units to 100. You can still play in that little mom and pop space where we were for about a year and a half. Then after that, you've got to say to yourself, I'm in multifamily because there's the scalability and there's the economies of scale. And I don't want to do the day-to-day grind. I want to create wealth and I want to create a real business. So that was a long answer, but I think that's trying to give you the inflection points of what my journey was like, from having nothing, having that epiphany, to actually looking for the first deal, to finding the partner, to closing on that first deal, doing everything myself, closing on the second deal, then all of a sudden trying to create some systems in the business, right? And having that inflection point, and then saying to myself, wow, these are all business centers. Because I started out as being a landlord. I thought, hey, let's go fix those toilets. Let's go, turn those apartment units. That's what it's all about. But when you start getting bigger and you start scaling up and having those advantages, you need to start hiring people to do that.
Yeah, that's awesome. I've heard on a number of your contents or podcasts that you started doing it yourself, and you kind of got to that point where you realize, hey, I don't know if you ran out of cash hard or whatever it was. It's like, I can't buy anymore. Okay, let me find out syndication. And so doing it yourself, though, you learned and you quickly realized these are the business KPIs, the drivers, the things that you can hit over and over again. And then you learned what was probably going to waste your time, and you could delegate to somebody else, right?
Yeah. And Abel, I think more importantly, that was my journey, right? I think everyone listening to it, just stop and reflect for yourself, just for 1 second. Are you building your dream, or are you building somebody else's dream? At the restaurant, I felt like I was building my dad's dream. And I really wanted to create something special. I wanted to create a great company with a great culture. And I didn't have that. So when you get into multifamily, if you want to have 30 or 40 or 50 or 100 units and you live a great lifestyle, that's great. There's nothing wrong with it. Just know what you want, right? If you want to go out and close 1 deal a year, that's fine. You want to close 17 deals a year, that's fine. Just know what you want to do. I know right now, everyone's saying there's not many deals out there. We're just looking at deals. We're underwriting deals. Everyone's asking me, when are you going to get to 3,000 units? To me, the unit count doesn't matter. It means that it means the quality of the deal. I'd rather do less deals per year, but really make them worth it. I was speaking to you offline. We just did a 48 unit deal. We're going to convert the office into 2 units. It's going to become a 50 unit deal. We paid $1.9 million for this. So it's around $40,000 a door. We're going to put $5,000 a unit in it, right? Because it was coming off a USDA loan. So we got it distressed off market. So we're going to be into it for $45,000 a unit. I know it's going to appraise in 18 months at $60,000 a door. You do 1 or 2 of those deals a year with your partners, you're set for life, because you're going to refinance all those proceeds out and pull extra money out. It's going to cash flow about 7 or 8 or maybe 10,000 a month. And then you have the tax benefits with the cost segregation. So you don't have to go into these 300 or 400 unit deals if they're not there right now, because I think right now there's a little bit of a dislocation in the market. You have so much money out there with PPP and SBA loans, and there's people with money out there. Don't let anyone kid you. There's a lot of money sloshing around out there, and there are not that many deals out there right now. So a lot of money chasing a few deals. You have those bigger deals that are going, that are getting sought by institutions. The smaller deals, the 50, 60, 80 units, those are really the mom and pop deals where the institutions don't really want them, but the mom and pop investors can't afford them. So to us, there's a little sweet spot there. So if you can find those deals, and for us, it's about the economies of scale also. If we can buy these deals next to our other assets, we'll just incorporate them into the management, into the maintenance of it. So that's why it works really well for us. We're vertically integrated, so we're managing our own stuff. So it really, to answer that question, it really comes down to, what are your goals? What are you looking to do? You can stay small in this business, have one handyman working with you and have a great lifestyle, or you can scale a portfolio up to 5 or 10,000 units, whatever you're looking to do.
Yeah, absolutely. Just absolutely depends on, your dream and what you want to go after. And that makes perfect sense. When we forget sometimes about the basics, like we're setting goals. Well, what's the end in mind? Begin there and then work backwards and engineer it. And you may be engineering a completely different goal. You wanted freedom. Well, that might be taking you clearly away from your freedom. But anyways, it's how we all got to operate sometimes. To start at the end, then move back. And if you can do that, you're going to have success. Well, so a number of things we've touched on a ton, even at this point, right? I heard a few things when you're running that business. I love people, culture, and systems. If you have the right people and have the right culture or have the right systems in place, then that's really, that's an applicable model across industries, across business as an entrepreneur. So what are a few things that you did or do to create that, that people, culture, system within your organization, within your investments?
Well, for me, it all started back at the restaurant once again, where I was always blaming the employees. Why are they showing up late, or why do I have terrible employees? And I know a lot of the people listening on this call are probably struggling with that also. And it didn't dawn on me until I was thinking to myself, well, maybe I'm the problem, right? You attract not what you want, but what you are. And I didn't have core values. I didn't have a mission statement. I didn't have systems in the business. So I was attracting what I was at the time. I was a mom and pop owner who was stressed out, who was trying to pay the bills. For me, the turning point was when I think was the owner of Southwest Airlines. He said something to the effect that, you first, as an employer, the first person you need to take care of is the employee. The next person is the customer. And the third person is the shareholder. Now, I was, you go to business school, they're like, you need to take care of the shareholder first. But if you're running a business, you need to take care of the employee, right? And we stress it, because the employees, if they're happy, they're motivated, they're taking care, they're delivering the amazing customer service like a Chick-fil-A, like an Apple, like those companies out there, the customer's going to be satisfied and they're going to come back, and you're going to build a great brand. And ultimately, when that happens, your shareholders are going to be rewarded. So always think about the employee as being the most important person on the team, because they represent the brand. So when you have, a 35, 40 unit apartment complex, somebody walks into the office, what's the first thing they see? Other than the vendors cutting the grass and all that, they see the property manager in there. They are the face of the brand. If that person doesn't do a great job, what do you think happens? Your brand suffers. So for us, really the first thing we needed to do about 2 years ago, Jake and I started scaling up this whole process. We started working with Vern Harnish's company, Scale Up. And we basically created our core values and a mission statement for us. Our core values are people first, extreme ownership, make it happen, growth mindset, unwavering ethics. Those are our 5 core values. And that's what we try to live by every single day. And they permeate through all of our different brands, whether it's our investment company, whether it's our mortgage company, whether it's our residents, whether it's our Jake and Gino students. We always want to use those core values. We hire off of those core values and we fire off of those core values. And we always check ourselves at the door and say, hey, you know what? This is what we need to do. We have a mission statement that we created. And really the culture is all about building that internal culture where we're trying to be as transparent as possible. We abide by the Rockefeller habits. We do our quarterly plannings. We have a cadence of accountability where we have weekly calls. We have quarterly priorities. I can go through the whole thing, but to me, it really, and that's where the inflection point was. When you're running 30, 40, or 100 units, you may not need this, but as you start growing and you start scaling, you're really gonna have to start looking into it. I would look into, there's a few books, Gino Wickman's book Traction is amazing for this.
Mm-hmm. Yeah.
I read his book.
Rocket Fuel is the next one, right?
Yeah,
Those two
and
books?
I'm actually reading Get a Grip. It's his parable on traction, because traction is a hard read. It's not something we're going to sit down on the couch and kick back and read. It's really, you have to implement that. But Get a Grip is really the parable on it. Scale by David Finkel is another great book. I think he wrote that with the founder of Priceline. I forgot what his name was. Gosh. And then Scaling Up was just an awesome book. All three of those, if you're in that mode, you have to look at those three authors and say, this is going to really help me out.
Yeah, very good. Thank you very much. That was a good insight. A lot of people think when you were jumping into the real estate, I know I did for 10 years, I was a single family investor. And so I always thought, it's me and my wife, and I didn't have to worry about communication outside of me and her, and ours was tight. But now that we're scaling, there's a pretty big team once you start to involve a number of doors and other projects.
So why did you scale? What made you get out of single family and go into the multifamily space?
For me, it was my original game plan was buy 10 single family houses and have enough for the renters to pay them off over 30 years. And then that would be my passive cash flow, my 10 grand a month, right? What I failed to plan for when I was 26 was the length of time it would take me to get 10 houses. So I was 39 and I finally got to 8. And I took some education training, and I was like, well, I'm doing it wrong. Let me go about it a different way. We did like another 8 to 9 deals in 1 year,
awesome.
Raising capital, really leveraging hard money lenders, creative financing, all the stuff I didn't know about for 9 years prior. Put it together, and then I go, well, man, this is crazy. I had another job completely. I had a full-time job while I was doing all this, but even that made me realize there was no way that I was going to complete that level of scale in my original plan, and I needed a better way. And that backed me up into multifamily, passive investing, and now general partner and active.
So what do you like about it more than single family, other than the single family is probably more of a grind. There's probably a lot harder to manage all those units.
Yeah. What I like, there's a few things that I like about it, but the most or the biggest ones is that I really feel like you're making more money in less time. You have better tax benefits, and like the biggest overarching, benefit that I don't think a lot of people really understand is the networking with just a different type of person. When I was networking, quote unquote networking in single family, I heard a lot of rough stories, distressed properties, divorces, financial issues, hardships, and that was, my customer that I served, trying to help them. And then on the flip side, I dealt with a lot of people that were in single family. They were trying to get into this active grind. And when I went to multifamily, now I have individuals like yourself and others that I'm learning from, getting education from, that are talking about ways to create financial freedom and wealth. And, here's how I made my first $1 million and $2 million and, multiple million. Here's the path. And I've never had so many people show me multiple different paths to creating multi-millions of dollars, right? Repeatable, systematic process, which, you pretty much laid out in the first 5 or so 10 minutes of this conversation, which is amazing. So that's to answer the question.
It's funny because I always use this quote from Mark Twain. It's not what you know it's not what you don't know that gets you into trouble. It's what you know for sure that just ain't so. Right? Because you knew for sure that if I buy 10 homes over the next 10 years and if I do it for 30 years, that's the slow way. And there's nothing wrong with it. And a lot of people have gotten rich off that. But you don't have to go that way, because everyone thinks that multifamily, you need a lot of money. You need a lot of experience. Well, Jake and I didn't have a lot of money, and we didn't have a lot of experience when we started. And what we've done in the last 7 or 8 years to me is mind-blowing, because I shattered those limiting beliefs. I went to coaching school. I found out that, hey, there's syndication. You can raise money. You can use other people's money. Didn't even know that about that strategy. Not that I didn't know, but we didn't start implementing it until 3 years ago. I didn't know that you could refi over $10 million from your current portfolio and buy the next deal. I did that, right? I didn't know about owner financing. I bought, almost 400 units on owner financing. So there's so many different strategies and tools in the toolbox, but people don't know that. And they don't even start because they're afraid and they're overwhelmed and they hear commercial real estate. I'm here to tell everybody that's a bunch of nonsense. If you're ready to just level up and to create a business, look into multifamily because it is an amazing business and people are going to need a place to live. The 3 basic human needs: food, clothing, and apartments, my friend. Because right now, I was actually reading a study today. 40% of millennials rent, right? And if you look at the numbers, it's amazing. Millennials are not getting married right now. They're pushing the marriage, right? Because they got student debt. When people form households and get married, they buy homes. So there's less people buying homes. You have baby boomers who are selling their McMansions, taking that money that they had, that retirement money, they're going out and renting or buying an RV. So I think, to me, going forward, multifamily is going to be strong. I think the whole transient nature of what's going on with the W-2 with the workforce, I think by the year 2027, 50% of the employment workforce is going to be freelancers. So they can live wherever they want to. So you can have a job in California and live in Texas. And that's going on right now. So I think multifamily, if you're in the right market, I think it's going to stay hot because there's money that's going to gravitate towards it. You have the tax benefits, like you said. One more thing, it's the cycle resiliency, we like to say. It's resilient somewhat to the market. If they're going to start doing the evictions and pushing them off, it may hurt it a little bit, but people still need a place to live. They don't need strip malls, right? They don't need these big box stores because Amazon's taking over. Office space, it seems like it's getting cut, right? Self-storage, we'll see what self-storage. Maybe people might be cutting back on that because they can't pay the extra $300 a month because they can't afford it, so they'll take their stuff out. I don't know. They say it's resilient, but I know people need a place to live right now. So
I 100% agreed on all that. And then to one of your earlier points, it's if you think there's not a lot of money out there, you're wrong. There's a ton of capital running around, and the term that I heard in a mastermind of mine was TINA. TINA. There is no alternative, and capital is searching right now for a yield, and it's going to continue to. And it's it's trying to hunt, if you would, where can I get the best return? And unfortunately, right now there is not a lot of alternatives, and so some of the institutional money buying up some of the properties that you and your team and ours would have been looking at, but that breeds an opportunity though for others that have capital that are not institutions that are trying to stick it somewhere to create a return. So what better avenue than one of the basic needs, right? I like it. Clothing, food, and apartments.
That's right, my friend. Food, clothing, and apartments. Just think about that.
Awesome.
It is. I mean, and we did a podcast with a gentleman named Chris Porter on our podcast. He is a demographer. He wrote the book Big Shifts Ahead. Don't take my word for it. Go read the book. There's about 140 million baby boomers and millennials in the economy right now, and their buying habits are different. They break down the decade by decade of all these buying and habits. That's how Uber was created. That's how Airbnb was created. We're in a sharer economy right now. They don't mind sharing because they're not as wealthy as their predecessors were. Our parents in the 70s and 80s, they had the nice ability to inflate. You bought a house back in 1970, 75, you bought it for $25,000. The house is worth $400,000 now, just from inflation and from putting money in the stock market, the big stock market boom. I think this generation now is pretty screwed. I think money is worthless. You see what's happening with gold. Gold is not really an investment. It's just a hedge. You put your money there to hedge. It's not really, you're not getting any kind of return. You're not getting cash flow from it. That's what you're looking for. You're looking for an asset that'll return some type of cash flow to you. So I think long-term, if you implement the buy right, the manage right, and the finance right, like we teach, you're buying these assets. I always say, Abel, no deal is better than a bad deal. You have to really stick to your parameters. You can't pencil whip, like we like to say. You can't make deals up. You need the discipline, and you need to know your numbers in the market, and you need to know, our rent's going to grow. Our rent's going to stay flat. Where are expenses going? That you need to know all this stuff, and don't overpay on an asset, even though you say to yourself, I think I can make money on it. You have to know your numbers.
Yeah. We're buying income streams. So if we're buying income streams, well, how do I know, what the yield is? How do I know the return? How do I know, all the factors of that income stream? And what you're saying is absolutely on point. So this is a good potentially segue right to what you brought up initially is, man, you didn't know how to do this in the beginning, and you laid out a really good plan. Education, massive education, you're trying to seek either pay to play or seek to serve. I did both of those, and that's what helped me kind of hit the fast forward button. But for somebody that's newer, talk about like underwriting a little bit. Talk about the mechanics of evaluating an income stream, and that might help somebody that says, oh, how do you even know? How do I know going to make money on this? I don't understand the mechanics.
Sure. So for me, I've got an 18-year-old son. He's a freshman in college. I'm making him go to school because I just want him to get that piece of paper. He's going to Flagler. But what's great about it, he's taking accounting. So right now he's doing assets equal liabilities plus owner's equity, right? Yes. And we're talking about retained earnings, and we're doing all the stuff in the last couple of days. I think it's basic financial intelligence. You have to learn what an asset is. You have to learn what a liability is. You have to learn what a statement of cash flows is. You have to be able to understand what a trailing 12, what a T12 is. If you don't know any of this stuff, pick up an accounting book and start learning. That's the first thing. The second thing, my son is working with Rand Partners. So he's interning with our Rand Partners team, and he's actually underwriting deals for them. So he started out, and it is a soul-sucking hard thing in the beginning. And as a parent, it's hard to see your children struggle because he's struggling in the beginning on underwriting deals, looking at, what the pro forma says. He's actually doing rent comps. And in the beginning, it was hard. And he kept asking me, Dad, how do you do this? How do you do that? I let him struggle because that's how your brain works. Your brain is really, it's got plasticity, right? You have all these ways in your brain that actually connect. And if you just give somebody the answers to something, it's too easy. There's no force in it. So I let him struggle, and it was hard as a parent. You have to continue to underwrite these deals, continue to put the numbers in, and you'll start seeing a pattern after a while. What I would do, if you're young enough, do what Abel did, do what my son is doing. Go work for somebody who's underwriting deals, help them underwrite the deals, let them teach you how to do it. At the very least, go out there and buy somebody's calculator, whether it's our calculator, Jake and Gino, Michael Blank's, you have Bigger Pockets, buy all of them, because what happens is you're not just buying the tool itself, you're buying videos on how to use the tool and also how to actually, derive the numbers, because putting in numbers is one thing. Understanding those numbers is a completely different thing. So going out there, finding mentors to do that. And then ultimately what you need to do, for me, the way I learned was just going out and getting a coach. I'm not going to lie to you. For me, I joined a coach back in 2008. I did a Rich Dad, Poor Dad. He had his whole calculator. He taught me how to underwrite deals. When you're looking at deals at the buy, right, you have to set up certain parameters for yourself. And this is something that I've learned over the last few years. The buy right is so fluid, right? It really comes down to the three pillars of real estate. You really have to look at the market cycle as the first one. You have to look at the debt component as the second one. And number three is the exit strategy. So form your buy right parameters around that. And it's fluid, because right now, when we first started back in 2013, I'll take you over a quick journey. Back then, everyone's like, the deals were great. Yes. But remember where we were in the market cycle? It was very risky. We were in a buyer's market. It was 1% GDP growth. One bedrooms were trading for $350 a month. That's what the rents were. Replacement cost was so low, but there was a lot of risk because the economy stunk, right? So at that point, we were able to buy C properties that were a lot older at higher cap rates, right? Now, fast forward to now, you're looking at properties, that are C properties, let's say in Atlanta, trading at 3, 4, 4.5 caps. You're at the high end of the market. Can it go higher? Maybe. But if you're buying those assets now and the market takes a turn and you've got to put a tremendous amount of CapEx, because big buildings have cast iron plumbing, they have aluminum wiring, they have a lot of CapEx requirements. Be careful of where you're buying in the market right now. Right now, we're buying assets that are a little bit newer, 80s, 90s builds. We like brick buildings. We like stuff that's, in the B space. We like stuff that's in the Knoxville market. We like it within 3 hours of Knoxville because we're vertically integrated. So in the buy right, select the market. And when you're first starting out, don't select 6 markets. If you're lucky like Abel and you're in San Antonio, great. Pick that. If not, find one market and focus on that market. That's the first thing. The next thing, figure out what the cap rates are in the market, right? The next thing, what is your cash on cash return? What are you looking to get actual day one? When we started back in 2013, 10% cash on cash actuals was pretty much a given, right? You could do that.
Yeah.
But remember, there was no money back there. There was no syndications back there. It wasn't like it is now. It was different. It was a different time, right? You couldn't raise rents like you did now, right? In 14, 15, 16, all of a sudden rents started rising. And as you know, when rents rise, NOI rises, you have the double whammy of cap rates compressing and income going up, you're putting fuel to the fire, right? Nobody would have known that, but that's what ended up happening. So, the buy rate, let's go back at that. You're looking at your cap rate. You're looking at the type of building you're buying. You're looking at the market that you want to invest in. Also, I think the other thing is, what is your investing strategy? For us, we're still value-add investors. We still want to look at a property where we're trying to solve problems. One of our coaches says right now he's looking at valuation through operation, not renovation. So if you've got a property that's operationally inefficient, you have these mom and pops, or right now in the pandemic, are they collecting rents? You may have some kind of management play going on right now where the expense is a little bit higher. Not just going in there, taking a 1970s build, ripping everything out, putting granite, spending $10,000 a door and turning that property over and flipping it. That's going to be risky right now. But if you can find properties that are operationally inefficient, that may be a play right now. So for us, we're still looking for properties that have, lower rents. When we look at a property, our additional income is between 10 and 15% of what gross income is, because we have moving fees, we have pet fees, pest control fees, all that. If we see that that's a lot lower than 10%, there's the value play for us. If we can raise rents, that's a value play for us. If we can lower expenses, that's the value play for us. So figure out what your business plan, because if you can buy something at an actual cap rate for today and raise that value, that cap rate goes up, you're going to make money doing that. So I could talk about buy rate for the rest of the show, but really, guys, focus on it. Focus on where you are in the market cycle. Then look at what kind of debt you want to put on it, right? Are you going to put community bank financing? Do you need bridge debt? Or are you going to use agency financing? Are you going to owner finance it? Look at that. And then ultimately, I want everyone to think of, you're buying a deal, what's the exit strategy? We like to buy and hold forever, but we've already sold a couple of deals because there's so much equity in these deals. We're just going to buy that property and put it in. The exit strategy, are you going to refi the deal and pull the money out? Are you going to sell the deal? You're going to hold it 3 to 5 years. That exit strategy is going to tell you what type of debt you're going to buy. And when you're looking at a deal, you look at it through that lens, of looking at it from market cycle, debt, exit strategy, and then chunk it does into your parameters. Does it fit your parameters?
Got it. Yeah. Thank you. That was some good points. I think, I didn't know you guys had a calculator. I'm excited. Yeah. I think that it makes a lot of sense. What Gino mentioned, but go get a Michael Blunt calculator, a couple $100. Go get a David Tupin calculator. Go get their calculator. It's all going to help you just understand.
And the great part about it is it's not just a calculator, because all the calculators, they derive net operating income, they derive the mortgage calculations, they derive the cash on cash and the cap rates. It's really finding out, taking a little bit of everything and making it your own, making you feel like you're comfortable. And then from there, working on everyone's different underwriting template, you can create your own, and then you can have your own template. That's the great thing. We have one at Rand Partners that we use for our syndication. My son's using that calculator, so he's comfortable with that one. Mm-hmm. And he's just continued to use that one.
Yep. I've used like Sapphire Partners for a while, and they kind of helped me run through it. And now I look at the numbers, and now I'm like, oh, okay, more comfortable. I don't want to glaze over the point that she said though, which was financial literacy. I don't know if that was your words, but that in my head, I go, yeah, you have to become financially literate. The same way you learn how to read and write, the same education can be had from the financial aspect. The numbers, the accounting, the basic principles. You're trying to figure out, a P&L statement. Here's your income, here's your expenses, how much is left over. And then he mentioned, in the financing part, well, how much do they want and what's left over for you? And so if you can start to learn those things, and some of the things that Gino mentioned, and this is exactly the kind of mindset that we all need to be in, to learn as much as possible so that you can start to use that education of yours and go on. So thank you for mentioning all those points. I do want to hit on manage right. Sure. And I do want to hit on finance right, because I think, man, let's stay within this field of expertise for you, my friend, because you are. I don't know if I mentioned this at the beginning. Gino is also a certified professional coach, so I can see it shining through even on a short podcast. Yeah, this is awesome.
Well, for manage right, let's really discuss the manage right portion. A lot of educators don't want to teach it. It's not sexy. It isn't. It's you're in the weeds, right? So there's a distinction. You would know this because you're a syndicator. There's asset management and there's property management. I never really dawned on me in the distinction until we were doing a boot camp about 3 months ago. We property manage all our deals, but we
Mm,
also asset manage our syndications. They are two different components, two different layers. Even if you're doing it yourself, you need to separate it, because if you're thinking about it, you're an asset manager. You don't want to spend any money. You're trying to get as much money back to the investors as possible. If you're the property manager, you're spending more money because I'm looking at my ceiling fan. I'm looking at my light fixtures. I want to spend more money because I want to be able to rent that property out for more. So know the distinction between the property manager and the asset manager.
mhm.
That's the first thing. The second thing is you need to set up KPIs when you have a management company. And if you're not managing and you're third party property managing, I would say to you, go through a program, learn how to manage properly. And then a lot of our students are teaching their property management companies, because a lot of these property management companies don't have systems. They're back in the 80s and the 90s. They don't have a Buildium. They don't have an Appfolio. You need that without a doubt. If you're getting into the multifamily space and you're just starting out, look at these smaller companies like Buildium, like Estessa or whatever. There's companies out there, Cozy, that you can start utilizing the property management software. We waited till about 600 units to jump onto Appfolio. That was probably one of the biggest mistakes we made, was waiting to do that. When we did, it was lights out, completely different ballgame. So everybody out there, when you're first starting out, make sure that your property management company, if you're third party property managing, uses property management software. And if you're doing it yourself, make sure that you utilize it. That's very, very important. KPIs, make sure you go through your KPIs, your key performance indicators. And what are they? For us, vacant rented, vacant unrented. You're talking about your delinquencies. That's a really big number. What are your delinquencies? We started tracking them about 18 months ago. You want to know what the delinquencies are: week 1, week 2, week 3, week 4. You want to know also, when you're looking at it, what your physical occupancy is versus your economic occupancy. It's a big number, especially during COVID. When COVID hit back in March, the end of the world was supposed to come and nobody was supposed to pay rent. So we got worried like everybody else. We started doing a daily tracker of rents from day 1 to day 30. April was good. May was good. June was good. July was good. We would see the trends, and it actually stood up. So that's something we needed to do as an asset management company for our syndications, letting our investors know, hey, we're tracking our delinquencies and we're tracking our collections. You need to get on, as far as the management goes, you need to get on weekly calls with your property management company, whether you're doing it yourself or you're
Mhm.
third party. Weekly calls at the minimum, because you know what? You're running a business. You want to make sure that they're allocating resources properly. You want to make sure that, hey, why are delinquencies $5,000 and we're in week 3? Let's step it up. Let's send out a text to the residents that they need to pay money. Or why is this happening? What's going on with the advertising? We have guest cards of only 20 guest cards this month. Last month we had 50. So stuff like that with your KPIs are really important with your management. And you want to be proactive in life. Whenever you're proactive in life with anything, whether it's your health, whether it's your family, whether it's your business, you can actually avoid it. That's the problem with health insurance right now. Health insurance it's not health insurance or health care. It's really, you're not really trying to avoid anything. It's just insurance, right? If we were out there trying to keep people healthy so they didn't need health insurance, that's one thing, but that's not what the healthcare industry is all about right now. That's the problem with that. So you don't want that to be pervasive in your business, where all of a sudden you're reacting to everything, putting fires out. Let's be proactive. Let's set those systems up on the front end. So if you're talking to your property management every month, and you see every month, by the week 3, we still have those delinquencies, well, that's something that needs to be addressed with your property management company. Either they're not doing the right job, or you don't have the right residents in there, and you need to change something up. So being proactive is really important. And I think the last thing I could say about it, like I said, talk about it with hours. We do a 3-step framework. I want everyone to follow this when they're managing their properties. First thing you need to do when you take a property over, you need to fill up your vacants. You need to fill your vacants at market. Very first thing. Next thing is starting implementing RUBS, a ratio utility billing system. A lot of mom and pops, believe it or not, do not bill back water. And ratio utility billing is big. And believe it or not, the other thing, pest control. We took over a property about 18 months ago in Louisville. It's only a $3 per month charge. Tenant, resident, landlord wasn't doing it. 130 units times $3. It's, what is that, $400 a month? It's $5,000 a year additional in our pocket at a 6 cap. That's significant income. That's a significant valuation when you're talking about a $3 per month charge. So looking at that, understanding, see, there comes the buy right back again, because all of a sudden the buy right is like, wow, they're not charging these fees. There's income there. There's where our ways I can generate wealth and valuation on the property. So knowing the market is really important. So
If I did the math right, $5,000 at a 6 cap, that's $83,000 valuation for the company at $3. You're
think
like,
about that.
Just turn the $3 over and there's an extra 83K in
valuation.
valuation.
Think about that. That's just from charging them something that everyone else in the market is charging them, right? So, I mean, that's nominal. That's nothing. So for us looking at that, implementing those things, you have to wait obviously for the leases to expire, but then when the leases renew, you push them to those new rents. And the third one is recent lease renewals. I'm sorry. When leases renew, getting those lease renewals to market rent. You want to get those to market rent. And every year you do those rent increases. We've been having rent increases every year. You have to check what's going on with your market. Knoxville, I think the last 12 months, rents were up 4.7% for the last 12 months. So it's, out of the top 5 markets in the U.S., Knoxville and Lexington, we have deals in both of those markets, are top 5 in the U.S. for people moving. So we've been fortunate, and that's why you want to be in a market where people are moving to, where there are jobs, because you're going to be able to increase those rents, because home valuations are up 7%. So you're thinking, oh, wow, you're going to outrent yourself, but not really, because home prices are going up even higher. So you have to have the ability to be able to still rent. It's still going to be cheaper than buying a home, and that's where we are still in Knoxville. I'm probably assuming it's the same thing in San Antonio also.
The market is pretty steady for the past 20 something years, consistent increase in population growth and people moving in, and feels like it's accelerated in the last several years. But, during the market downturn, 2008, it wasn't really a downturn for San Antonio, Texas, or our lower markets. It was stabilization, not growth. And now, it just continued to rise and, up and to the right slowly. It's kind of the boring, consistent, steady growth, which is what we appreciate.
Yes.
No ups and downs, just steady, constant, and growing. So it's been good. Yeah, it's been really good.
It's
and
awesome.
Then the like you said, market rents. We don't have any problem today. I haven't checked the market vacancy, but I think I remember it's always sub 5 in general. And, obviously depending on which sub market, but it's been pretty good, filling the apartment complexes so far. Hello. This is Abel Pacheco, your host for the 5 Talents podcast. After listening to a few episodes, deep down, do you know that multifamily and commercial real estate investing is one of the best ways to create financial freedom? If you said yes to that question and you are where I was a few years ago, then I'd absolutely love to connect with you. A few years ago, I started personally consuming a ton of real estate education. I traveled all over the country, as many real estate conferences and seminars that I could go to. I took 200 plus hours of real estate education. I spent thousands of dollars along the way. And I did this because I knew the path to financial freedom for me and my family was through commercial real estate and syndication. So if you've made a similar decision, I'd love to connect with you. And potentially in the future, I'd love to partner with you as well. Take a moment, go to 5tcre.com/invest, and I'd love to set up a time to talk. That's awesome. Everything that you mentioned, I think that's awesome. The 3-step process, right? To manage right. And then, before we go, the finance right. So financing is something that I am personally digging into a lot more these days, as it's been 2 years since I started commercial real estate. Now I'm, a little more comfortable underwriting, and now I'm, kind of keep continuing the further into the financing side of it. So curious to hear this side of it, because man, a few percentage points or 1 percentage point over a few years amortization, it's a big difference. So I'd love to hear, what you mean by finance right.
So for Abel, for us, it was also that progression, that transformation from beginning till now. We started out, and a lot of our students start out with smaller deals, right? You start out with community banks. People frown at community banks sometimes. We love them. They're easy to work with. We're doing 85% LTVs with our community banks still. Wow. Now the next deal, we're going to see how we're going to land. But the deal we just did, we're doing an 80% loan to cost. So we're getting 80% of the rehab budget in the deal. They're very easy to work with. Their rates are a little bit higher than agencies. They've got 25-year amortizations for the most part. They've even gone and they're doing a little bit of interest only now. They're a great place to start. And I think right now, when Fannie and Freddie came on the pandemic and they were putting on loan reserves and all, community banks are a lot easier to work with.
Mm-hmm.
For us, the other one, transitioning into Freddie, SBL, and Fannie, you need experience with Fannie. Freddie, you may be able to do your first deal. So that's why you transition from community. And what we've done is we've used community banks as quote unquote the bridge. We'll buy a deal with community debt financing, rehab, season it, and then from there we've gone back to the community and refied, and then gone from that community and refi to agency. So we've done 2 refis in a lot of our deals. Because when you buy it right, so that's the thing you need to know in the market cycle. In the market cycle right now, when people are buying these properties at 4 caps and there's not much valuation on there, you can't really refi a deal. But if you're buying a deal like we just did, like I said, at 45 a door, you're going to be able to refi that because you're buying it right. So that's one of the strategies we like to use with community banks. If not, agency's great. They've got great terms, 3 years, 5 years, 7 year. IO, all term. It's all depending on what you're looking for in that deal, right? Mm-hmm. We like right now, as far as the Fannie deals are great out there. I mean, you're getting sub 3%, around 3% for these loans. The money's really cheap right now. So like I said, we started out with community banks, we've gone to agency, and now we're going back to community. So you really need to know where it works for you and what your business model is. Obviously, community banks, it's going to be harder to syndicate a deal because they're recourse loans. If you're going to take all that recourse on yourself and your partners, it's one thing, but I know it's a little bit harder to do it when you syndicate a deal. So we're buying it, we're using community banks when we're buying stuff for ourselves.
Yeah. That's awesome. All the nuggets are good. And the creative part in the beginning, the way you're applying it, made a lot of sense. And if you can't quite grasp that, let's say on a single family house, if anybody owns one or a few of those, you can take them back over some period of time. The principal has been paid down. You take them back to the bank and you do a refinance and you pull some cash out, especially if you forced it. And we call it BRRRR, right? The buy, renovate, rent out, refinance, or whatever. So the same applies and repeat. Yes. So you're like, okay, well, same properties, community, agency, community.
Yeah. So I'll give you an example. On our very first deal we did, it was a 25-unit deal. We paid $600,000 for it. We paid it was $83,000 down, 10%. We got 10% owner finance note on it, right? Okay. So it was for a $600,000 deal, we needed $80,000 to control that asset. That was pretty freaking amazing, right? Yeah. Yeah. We got terrible terms on the deal because we had owner financing. At the time, 7 years ago, we got a 6% interest rate. We got a 20-year amortization, right? But they allowed us to do owner financing on it, which was fantastic. Yeah. We pushed up rents. We did what we had to do. 18 months later, when we went to refinance it, we were able to pull out $180,000 from the deal. We extracted $180,000. We cashed out. The deal terms were 25-year amortization, 4.29% interest rate. So with all that debt that we put on, our payment didn't go up at all because our amortization got pushed out and our interest rate dropped over 1.5 points. So you can see all the value we created, right? We pulled all of our money plus another $100,000 out. So we have no money left in that deal. We still own that deal today. It produces $6,000 a month positive cash flow every month for the 3 of us. And that asset's just going to sit there and it's just going to continue to print money for us. That's what you want. You want all these little soldiers. One deal like that a year will set you free. That's all you need.
Yeah, that's awesome. So encouraging and super exciting. So a couple of things before you go. Thank you very much. All this has been just a fantastic interview, and I really appreciate it, Gino. The Youth Academy, before you just leave on multifamily, what is the Youth Academy? We were talking about this earlier, and I'd love you to highlight this. For listeners.
So for me, I've been really digging deep, and I'm gonna pitch a couple of guys that I have no affiliation to, but I just want to get it out to students and to parents out there. The Tuttle Twins is a great series. I think the gentleman's name is Connor Boyack. I podcasted him on the Multifamily Zone podcast a few weeks ago. His theory is all about liberty. He's a constitutionalist. He talks about the Federal Reserve, but he writes it in these really colorful books for children to read. They're for young adults, young kids, teens. Look at the Tuttle Twins. The next one is the Uncle Eric series. It's Who Stole, I think, Penny Candy. I forget what the book is, but just look under Uncle Eric and Penny Candy. Great books for teenagers and young adults just to read, learn about what inflation is, learn about what the money supply is, learn about history, why did Rome fall? Rome actually fell because they were debasing their currency. They used to have coins with little ridges on them. Then they started filing it off. That's why they put the ridges on coins, because they were debasing their currency. They used to have silver in their coins and they were making it cheaper. And then it was only copper, right? Well, what happened back in the 70s? We got off the gold standard. It's the same thing. History repeats itself. So that's an amazing series. And for me, I like Dave Ramsey. I think he does really well with people who are less financially, I guess, capable, middle class. I don't want my kids to learn the middle class of just saving money and just staying out of debt and cutting up your credit cards. I want you to enjoy life. I want you to have credit cards, but use them responsibly, right? Because we're going to a cashless society. Whether you want to believe it or not, we need to be able to use credit, right? I want my children to know the difference between business debt and personal debt. And if I don't teach them, who's going to teach them, right? I mean, you need to have an emergency fund. I love what Dave Ramsey talks about, that you need to have some type of safety fund. That's great. But then after that, I don't want my kids saving for retirement. I don't want my kids ever retiring. I want them to continue to work and to enjoy and do what they love to do, but save to buy assets like I'm doing, and having those assets pay for your living, pay for your kids' college. That little property right there is going to pay for all of my kids' college for the next 10 or 15 years. That one little property where they tell you to go put money in a 529K. Once that 529K is depleted, there's nothing left to pay for the kids. That's why I think that financial intelligence is really lacking. We're not learning it in school. In college, they're not really teaching it either. Basic fundamentals, but they're not teaching how to invest. They're not teaching what skills you need to learn. They're not teaching what parents should teach their kids. They're not teaching about taxes, right? They're not teaching about entrepreneurship. All these things are so important for us. And if we're not teaching our kids, I personally think, Abel, what's going on right now, this is not a race war we're having. I think it's a class war we're having right now, because people with financial intelligence can change the world for the better. If you're financially intelligent and you can stay home from the pandemic, you're living a pretty good life right now. But if you're struggling, you don't have any money put aside, you're not financially intelligent, it's going to be really, really hard for you right now. And I can see the chasm right now. And I want kids to learn that they don't have to do what they were always doing. This is a different economy right now. It's built on debt. And if you know how to utilize debt and utilize it wisely, I think you'll be better off.
Yeah. Yeah. And so the Youth Academy, essentially, that you're taking time, effort, and energy into like a program. Is it a program? Is it a school? Is it a series
what
of
I'll
books?
What I'll do is I'll leave you a link. You can find a link in your show notes. It's a Jake and Gino program that we created. It's all virtual. It's all a training platform that we've put together. There's about 70 or 80 videos in there.
Wow.
So it's I even have some personal development in there, because we're a life coach. So personal development, how to set goals, even choices. People say I don't have a choice. Well, when you don't have a choice, that's your choice, not doing anything. So just knowing that kind of stuff and learning that kind of stuff is really important. So
yeah, that's awesome. I'm trying to remember. I guess I'll have to put it in another one, but I just interviewed another individual. He's doing something similar, writing some really great children's books, The Little Library, I think it's called. But anyways, that's awesome. I love the way you give back. You've achieved. You've made some great, leaps and bounds from the days of running your pizza shop and your father, and now you're having tremendous success, and now you're trying to give back to others, and that's just so, this just so the right thing to do, and I love hearing it, man. So
what's great about it, what's really ironic about it is when you start making money, and you don't need to make money anymore, you don't focus on just making money, you focus on creating wealth, and you focus on helping others. But the irony is, the more people you help, the more money you make. You know what I'm saying? So that's the irony, isn't it? Like, you think, oh wow, it's scarcity. I always had the abundance versus scarcity mindset, that if I show everybody and I teach everybody, they're going to take it away from me and I'm going to make less money. Well, the irony is not really, because it's not a zero-sum game. Real estate is, you buy the property from me, I made money, you're going to make money in that deal also, if you know what you're doing. So it's something that's really strange. And you're out there, you're trying to get better at what you're doing. You learn, you do, and then you teach. And then honestly, when you're teaching stuff, you become so much better and so much wiser. And I did it for selfish reasons also. I did it because I was having problems finding stuff for my kids. I was having problems, where can I find stuff for them to learn? And then when I found the Tuttle Twins, it's great series there. When I found, Uncle Eric's books there, that's great. But I said, I can add something to it also. And I want to learn how to teach my kids. So when you're teaching stuff, man, you learn it so well yourself, and you push yourself out, and you become a better educator, but you also become a better student.
Yeah, that's awesome, man. Well, thank you very much. And before we go, if somebody wants to get more, further in your world, Gino, they want to learn from you, take some education, coaching, invest, whatever the case may be, tell everyone how to get a hold of you. What's the best place to reach you?
Just go to jakeandgino.com. You'll see the resources there. We have 4 weekly podcasts. We have blogs. We have articles. If you want to, just email me at gino@jakeandgino.com. I'll send you a PDF copy of our honeybee. That's gino@jakeandgino.com. I'll send you a PDF copy of the honeybee. I think you'll love it. It's a business parable that we wrote. If you want, I can send you a copy of the Wheelbarrow Profits also. Just reach out. I mean, it's the first start. It's just inundating yourself, getting yourself educated, seeing if multifamily is the right vehicle for you.
Yeah, that's tremendous. That's great. And before we go, is there any other topic, anything that I haven't, quite asked you about that you were hoping to highlight? Just any last nuggets, anything at all?
I think the only nugget for everybody listening is you need to be clear about your life. If you're asking yourself, is this the right time? Maybe it is, maybe it isn't. All I know is 2013 was the right time for me to buy my first deal and to get into multifamily. I had podcasted Jay Scott the other day from Bigger Pockets. He started flipping homes back in 2008. Do you think that was a good time to start flipping homes? Well, after 300 homes and $50 million later, it obviously was, because he was ready. You need to be mentally ready. You need to figure out what your why is. You need to figure out why you're doing it. Once you have that, just start. Pick a vehicle, single family, wholesaling, multifamily, whatever that vehicle is, pick that vehicle, really learn it, stay in your lane, no shiny object syndrome, and sooner or later, be married to the work. Be divorced to the results. That's all I have to say. Don't worry about what your results are, because if you continue to work and continue to grind, you will hit those results.
All right, Gino, thank you very much, man. I sincerely appreciate the time. And again, my name is Abel Pacheco. I'm the host of your 5 Talents podcast. And if you want to get a hold of us, our website is 5tcre.com, 5tcre.com. A lot of the things that, all the nuggets that Gino mentioned, I'm going to link as many of these things in our show notes, so you can go click them. And then if you're looking for extra resources on, learning, education, podcasts, we have a lot of them on our education page. So feel free to hit that as well. And I'm sure Gino's as well has probably a ton of content there too. So thank you very much. We hope you appreciated the show. If you got some value out of it, please leave us a comment, put a 5-star rating on the podcast, leave a little note for Gino, let him know what resonated the most with you, and we would appreciate it. And thank you very much, Gino.
Abel, have a great day. Take care, everybody.
Yes, sir.
Thanks.
Thank you all. Bye-bye. Thank you for listening to this episode of the 5 Talents Podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who follow their dreams and achieve massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the 5 Talents Podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked, tell us your favorite guest, give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the 5 Talents Podcast.